Hello everyone, hope you're doing well. Welcome back to the Road to Retiring channel. Today I want to have a look at Disney, thanks to this comment from Options Backtesting on our PayPal video. Now if you look, he's asked what do we think of Disney, and says they seem like good value to him if you have a little bit of patience with their Disney Plus streaming, and if they can get back to their previous earnings. So that's exactly what we're going to do today. We're going to have a look at Disney's value and what we think that future value could be. And if you enjoy this kind of content where we do this, please do drop it a like, subscribe, and drop a comment down below for any other stocks that you'd like to see me talk about. Going straight into Disney's financials, I want to show the current situation they're in. So you can see that this is not great. There's a lot of red here, minus 27% earnings growth from 2015. And this is because in 2020, the COVID pandemic had really negative impacts on their business, causing their net income to fall through the floor. Because of this impacted all the other sort of metrics we like to look at. Their return on invested capital has been impacted by this. Typically it was above that 10% before 2020, and similarly their free cash flow obviously is not great right now. So based on this, their current financial situation being so poor, we're going to set our margin of safety quite high at 25%. But I do want to look at what they're doing to try and counter this. If we open up their earnings presentation, we can see that they're targeting 5.5 billion in cost savings, and this should result in a more cost-effective, coordinated and streamlined company, and they're committed to running this business more efficiently to enhance profitability. Additionally, on this presentation that they released with their earnings, I found this slide really interesting. They're optimistic about their ability to declare a dividend by the end of calendar year 2023. Now, Disney historically had a dividend, but they had to cut this completely during 2020 in spring due to the significant impact of the COVID across their business. So it's going to be interesting to see what yield this starts at. I can't imagine it will be particularly high, and they do say on here they believe that they'll be on track to declare a modest dividend. So in terms of where that yield's going to sit, it's difficult to judge, but they have said modest, and I can't expect it to sit too high to begin with, but hopefully it will have some nice growth rates once it's released. Lastly, on this earnings presentation, I want to talk about their non-GAAP reporting, because the reporting in terms of their earnings per share is very different if we look at the non-GAAP measures versus the GAAP measures. And that is because if we look at the bottom paragraph here, the GAAP measures include the amortization of 21st Century Fox and Hulu after their acquisition in 2019, and the non-GAAP financial measures are excluding this. So this is causing quite different results, and we're going to be focusing more on what the non-GAAP is looking like in this video. If you look at how different these are, you can see the earnings on the non-GAAP measure were $3.53 earnings per share reported in 2022, compared to what their actual GAAP EPS was of annual $1.73. So that's about a 100% difference between the two reporting styles. And so when we do make our calculations, we've got to make sure that we're using the right price over earnings metric to look at this. And because we're going to focus more on the non-GAAP and the growth that's forecasted here, we're going to be using the historic non-GAAP price over earnings metrics and valuations for our calculations. I want to go straight into what we sort of set as our values, and all these yellow fields are the things we're updating to impact what our buy value could be and what our future projection of the value will be. For the dividend yield, I have this at 0.0%. Obviously, we are expecting a dividend at the end of the year, which I showed you on that presentation, but it's very difficult to judge where that dividend's going to sit. So for now, I'm going to leave it at 0, but have the discount rate at that 9.5%, and then we'll look at the end of the video at how a different dividend yield could potentially impact some of the valuations. I've set this high margin of safety of 25%, as they are already in that financial trouble that we've seen. And share dilution, I've gone for 0.5%. Now historically it was 2.17% from 2018 to 2023. However, you can see most of this was from 2019 to 2020, where they issued a lot of new shares, and it stayed at a pretty stable rate since 2020, only moving up 10 million from 1,817 to 1,827. So I haven't included massive share dilution, but I have put a little bit in just to forecast that potential possibility. Now, if we look at the earnings growth rate, this is very much where we're taking the analysts at their word for this estimation, as things like the realistic growth rate calculation completely go out the window when a company's earnings drop in the way that Disney's have. So, as you can see, analysts are expecting earnings to rise from $4.14 per share in 2023 to $7.68 per share in 2026. So we've gone with that estimation at 23.5% earnings growth, going from $4.14 in 2023 to that $7.68 value in 2026. Now, if we do take the analysts at their word on this, and we use a price over earnings multiple of 15, remember this is the non-GAAP we're looking at, and the sector median for Disney's sector is around that level at 15.3, and if we look at their historic price over earnings ratio prior to that Hulu acquisition in 2019, this was very similar to the non-GAAP and the GAAP measures, and it traded, you can see, around that 12, 14, 15, and then up to 18. So 15 is very much a sort of median point that it usually went back to levels around that value. So I feel comfortable with a price over earnings multiple of 15 with an earnings growth rate of 23.5. I say that's very much taking the analysts at their word. If we do see those results based on the price over earnings metric, that would make the fair value $82.91 with a 2028 price of $174.02. So there is some quite nice growth there, even if you were to get in now. But as I say, because we have this high margin of safety at 25%, because of the difficult situation Disney are currently in, we set this fair value a bit lower due to that margin of safety, because we want to make sure that it's really at a bargain price if we're going to risk investing in a business which is currently in such financial trouble. Now, price over sales is where things become a little bit easier. Now, if we look at Disney's revenue, this obviously hasn't seen the drastic drops that were seen in earnings in 2020, so it's much easier to forecast what the price to sales ratio could be, as it hasn't been so sporadic during this time. And they're expecting revenue to grow from $90 billion in 2023 up to $109 billion in 2026. So we've put that forecast into our calculation from $90 billion in 2023 to $109 billion in 2026 with a 6.7% revenue growth rate, and we've gone for a price over sales multiple of $2.70. Now, if we look at Disney's price to sales historically, if we ignore this really high jump in 2020 when Disney's price sort of rocketed after the COVID pandemic, if we ignore those values and look at the levels it's tend to sit at generally around there, it's pretty much at those levels at 2.7, 3, back down to 2.7, 2.6, then back up to 3, and it very much trades pretty stably between those levels at around 2.5 to 3.5. So we've gone with a price to sales multiple of 2.7 to be a bit more on the cautious safe side, and that gives us a fair value based on the price over sales of $85.65 with a 2028 price of $179.77. So it's actually really solid values for Disney, because despite it being still 15%, despite the buy price being 15% under the current market price, this 2028 price would still be really good returns if you were to get it. So the price to sales looks pretty good. And lastly, we've looked at the price over operating cash flow fair value. Now here again, it's similar to the price over earnings. We can see that net income is expected to reach around the 21,000 mark in 2028 based on these expectations. So if we go with those expectations for price over operating cash flow, expect that to sit a little bit higher when you include things like depreciation. That would put operating cash flow value around 24 billion in 2028. So we've gone for a 32% growth rate, which is very, very high. We have gone for a bit more of a conservative 12 operating cash flow multiple, which is pretty much where it trades. If we look at how the free cash flow trades, the operating cash flow is typically a little bit below this, it's around 50% higher than what the free cash flow is on general. So if we have a look at the financials, you can see statements, and annually when the free cash flow is 8 billion, the cash from operating activities is 13. When it was 8 billion, it was 12. High, basically 10 billion, it was 14. So typically around half of the free cash flow is added onto the free cash flow to get that value in the cash from operating activities. And so taking that into account, looking at the ratio of 17, this would bring the price operating cash flow to around another 33% drop off, take out about a third off of the average fair value here, and that brings us to the fair value that I've put in of 12 as I think a reasonable operational cash flow multiple to use. And based on that, the fair value for that is still coming under our buy price, and it would be a 2028 price of $154.04 with a fair value of $73.39. So when we take all of these into account and we get our average fair value for 2028, this gives us an average fair value of $80. Now, this does have some quite nice returns from current levels, so it doesn't mean you should sell by any means. We have a look, the current price at $101, the 2028 price is sitting at $170, which would be a 10.85% return each year. So there's still some really good returns, so definitely does look like there's some good value there. But just because of the high risk situation they're in with the current financials and net income being at such a low level, we have to add that 25% margin of safety to make sure that we're only picking this up if it's at a really, really, really great bargain. And so that's why I would like to wait for it to come down to levels around $80 before I'd really be interested in potentially picking some up. But we haven't touched on the dividend yield yet, and it will be interesting to see what that is brought in at, and if they do bring it in at around a 1% dividend yield, and then our discount rate will fall to 8.5, you can see that that increases our compound annual growth rate, if we include dividends, to around 11.89%. So it could be really interesting to see if they do bring that in and at what level they bring it in at. But for now, I feel more comfortable leaving it a 0 dividend yield with a discount rate of 9.5, because I just don't know what levels that dividend yield is going to be brought in at, and I don't know how that's going to impact their potential to grow earnings if they're not able to reinvest as much funds as they're spending it on dividends. So that's my sort of overlook on Disney. As you can see, by no means is it looking like a drastic sell, but because of all of the negative impacts on their net income and things like that recently, I've had to include that high margin of safety. So I'd be looking at around the $80 mark to pick some up at a buy price. I hope that has made sense, and please do drop it a like if you enjoyed the video. As I say, let me know in the comments if there are any other stocks you'd like me to take a look at. But this has been Road to Retiring. I hope you enjoyed, and bye.